Good morning, investors, and welcome back to the Daily Hunt for Multibaggers. It's Tuesday, February 10th, 2026, and we're here to break down all the market chatter from yesterday, February 9th.
That's right, Ethan. Our AI dug through a substantial number of discussions yesterday, flagging a broad range of stocks. It feels like the market's pulse is a bit mixed, with some strong bullish undercurrents, but also quite a few critical whispers, especially around high-flying growth names.
Yeah, a lot of different stories playing out, from tech giants pushing innovation to some more speculative plays capturing a lot of user attention. Definitely an interesting day for market commentary. All right, let's jump right into it. First up, we've got Microsoft, or MSFT. Our AI flagged a distinctly bullish sentiment here, with a lot of talk about the stock being beaten down, but still a great company. Users are making some high-conviction bets, even on short-term call options, clearly seeing a rebound to potentially 500 or more. Plus, the news on Microsoft's expanding AI ecosystem and Copilot success is definitely building a strong growth narrative.
Well, Ethan, while the user sentiment is indeed bullish and those AI initiatives sound promising, we always need to look at the numbers. The price-to-earnings ratio at around 25.9 is reasonable for a growth tech company. And yes, their revenue growth at nearly 17% and a net profit margin of over 39% are excellent. The insider buying, over 400,000 net shares purchased, is a very strong signal. But remember, there were also some cautious news pieces about AI capex and warnings to Magnificent Seven stocks. While the sentiment is high and the fundamentals are solid, we still need to see those AI investments fully materialize into sustained, accelerated revenue.
I hear you, but the significant insider buying, combined with that solid revenue growth and the price being about 25% below its 52-week high, suggests a strong conviction from those who know the company best. And those AI catalysts really do have the potential to drive future growth. Given its previous rating as stay away just a few weeks ago, I think the sentiment has decisively turned.
Agreed. The insider confidence and robust financials, plus the clear strategic direction, definitely make a case. For MSFT, we're classifying this as a buy. Next, let's talk about Apple, AAPL. Our AI picked up a bullish signal here, largely centered around their big moves into AI and augmented reality.
Absolutely, Brooke. The talk about CEO Tim Cook promoting visual intelligence and that massive $2 billion acquisition of Q.AI, an AI audio startup, shows Apple is serious about future growth beyond just the iPhone. They're positioning themselves for the next big wave in tech with smart glasses and enhanced AI, and that's a huge positive for long-term potential. Insider buying, even if a small percentage, also signals confidence. It does, Ethan, but let's be real about the valuation. A PE of almost 35 and a price to book nearing 46 are high, even for Apple. That means a lot of future growth is already priced in. While the revenue growth of almost 16% and a net profit margin of 27% are great for a company of this scale, the high valuation and some broader warnings to the Magnificent Seven from Bank of America mean we need to be cautious. These future AI gains have to deliver, and deliver big. I agree on the high bar, but these strategic AI investments are exactly what's needed to sustain that premium. The market is betting on it, and the insider purchases, small as they are, suggest internal belief. Given the recent string of stay-away ratings, this shift towards aggressive future tech, in my opinion, warrants an upgrade. I'll give you that the strategic pivot is significant. So, for AAPL, we're cautiously optimistic. We're classifying it as a buy. Switching gears to NVIDIA, NVDA. Now, the original post had a bull undercover statement for earnings week, and the news continues to highlight their dominance in AI, with some even speculating on a $300 price target by 2026. Their revenue growth is exceptionally strong at over 62%, and that net profit margin is an incredible 53%. Exceptional is an understatement, Ethan, but we can't ignore the elephant in the room, the valuation. A PE of 45.9 and a PB of 38.8 are extremely high. This stock is truly priced for perfection. Any slight miss or even a slowdown from its hypergrowth could lead to a significant correction. Add to that a debt-to-equity ratio of over 9, and critically, net insider selling, over 2 million shares sold in the last 6 months. That's a red flag, especially with upcoming earnings on the 25th. We've seen this before. It was a cautious buy last week, but the risks are stacking up. Well, it's a leader in a booming sector, but I understand the concern about the valuation getting ahead of itself.
Exactly. While the growth is phenomenal, the financial leverage and insider selling, combined with the already stratospheric valuation, suggest extreme caution. For NVDA, we have to classify this as a stay away. That's a downgrade from its recent cautious buy.
Next up, hims and hers, HIMS. Now this one's been a tough ride. Our AI showed an overwhelmingly bearish sentiment, primarily due to that lawsuit from Novo Nordisk and the FDA crackdown on their GLP-1 drugs. You can say that again, Ethan. Users are calling it fooked and highlighting that a third of their revenue came from GLP-1 sales, which is now severely threatened. The stock is near its 52-week low, and while they had some historical revenue growth, their net profit margin is a thin 6%, and the debt-to-equity ratio is a staggering 192. That's a lot of leverage for a company facing existential legal and regulatory threats. Despite some insider buying in the last 6 months, that's a backward-looking metric that doesn't account for the immediate and severe impact of current events. This has been a consistent stay away in our analysis.
Yeah, I mean, the potential for a dead cat bounce or the non-GLP-1 business segments might appeal to some high-risk traders, but the immediate future looks incredibly challenging. The community is very concerned. The risks are too significant. For HIMS, it's a clear stay away. All right, let's talk about a Canadian powerhouse, Toronto-Dominion Bank, TD. The sentiment around this one is very bullish. And for good reason, Brooke. Users are saying Canadian banks literally print money, and shorting big banks is like shorting modern civilization. It's seen as incredibly stable, with some even claiming it's up 100% in the last year. That dividend yield of 3.28% is attractive, and the insider buying is off the charts, over 4,000% net shares purchased in the last 6 months. Plus, news about new defense financing and exceeding market returns really paints a strong picture. Well, the KPIs certainly back up that sentiment. The stock is indeed near its 52-week high, and a PE of 11.43 is quite reasonable for a stable financial institution. An ROE of nearly 17% shows efficient capital use. And yes, that massive insider buying is a huge vote of confidence. This isn't just sentiment, it's backed by very solid conservative financials. The upcoming earnings report on February 26 will be key, but all signs point to continued strength. This was previously rated buy, and it seems to continue to be a good one. Completely agree. For TD, we are classifying this as a buy.
Moving on to Tesla, TSLA. This one always generates a lot of buzz. We're seeing some users believe it's hard to short and that Musk's influence can defy logic, especially with the news of the Optimus Gen 3 robot with a 1 million-unit production target. That could be a game changer.
Game changer or staggeringly enormous amount of work, as Musk himself put it, Ethan. While the robot and AI focus are exciting future prospects, the current PE ratio is an astronomical 382. That means an unimaginable amount of future growth is already priced into the stock. Add to that negative revenue growth of over 3% and a thin net profit margin of 4%. The debt-to-equity ratio is also very high at almost 18. This stock has consistently been a stay away in our analysis, and while the robot news is intriguing, it's purely speculative.
But you know, the community commentary often points to its unpredictable resilience. It's not always about the traditional numbers for Tesla.
And that's exactly why it's so risky. While it defies logic for some, for us, it means the fundamentals are not there to support the valuation. For TSLA, we're classifying this as a stay away. All right, let's turn our attention to Amazon, AMZN. The initial post was a buy the dip call, but our AI picked up a mixed sentiment overall, leaning slightly bearish. I think there's a good case for buy the dip here, Brooke. Amazon's making huge strategic AI investments, US $200 billion plans, and an AI content marketplace. Recent jaw-dropper earnings have analysts bullish, with some even targeting $300 by year-end 2026. Revenue growth is solid at nearly 14%, and profit margins are over 10%. There's even some modest insider buying. Ethan, the PE ratio is still high at almost 30, meaning a lot of that future AI growth is already factored in. And the current price is about 19% below its 52-week high, which isn't exactly signaling a strong upward trend right now. I'm seeing highly upvoted comments that are deeply skeptical, like the satirical one about warehouses and the stock price still being $200 in 2040. Users are complaining about Amazon trading sideways for years and in shitified Prime services. Plus, Bank of America issued a harsh warning to the Magnificent Seven, which includes Amazon. This was a stay away recently, and I don't see enough to change that.
Fair points on the user skepticism and the valuation. It's definitely a more complex picture than just the AI narrative.
Indeed. For AMZN, we're sticking with stay away for now.
Next up is Robinhood, Hood.
Our AI flagged this as bullish, with users hoping for strong earnings and predicting it will be back over $120 by March. It's definitely seen some parabolic moves recently. Plus, that net profit margin is an impressive 52%, and we saw significant insider buying, over 46% of total insider shares held.
Ethan, while the enthusiasm and profit margin are notable, we can't ignore the risks. That debt-to-equity ratio is an alarming 188.79. That's a huge amount of leverage. And the beta is 2.44, confirming its extreme volatility. Users might be calling for 120, but other comments are talking about getting fucked on call options due to those wild swings. The PE is also relatively high at almost 34, suggesting a lot of that hope for growth is already priced in. This was a stay away last week, and I don't see enough to mitigate these major red flags.
It's a high-risk, high-reward play for sure, and those insider buys are usually a great sign.
They are, but the underlying financial structure screams caution. For Hood, we classify this as a stay away. Last but not least, Snap Inc., Snap. The sentiment here is overwhelmingly bearish across the board.
Yeah, despite a post about a perplexity delay being resolved, the community is really down on Snap. Who TF even uses Snap anymore, one user asked. They're facing huge competitive pressure from Meta, and there's talk about a lack of clear profitability or cash flow.
The numbers don't lie, Ethan. A negative net profit margin of almost negative 8% and negative EPS of negative 0.27 clearly show it's unprofitable. The debt-to-equity ratio is extremely high at 181, and the stock has been in a consistent downtrend, trading near its 52-week low. Even insiders have been net sellers. The international revenue trends news is a potential positive, but it's not changing the core financial picture right now. It has consistently been a stay away.
It certainly sounds like a tough one. For Snap, it's a definite stay away. And finally, we looked at AST Space Mobile, ASTS. This one is a truly polarizing stock with very high hopes from some, but also significant skepticism.
Polarizing is right, Ethan. Our AI flagged it as cautiously bullish, but the risk is off the charts. Users are dreaming of $200 a share if launches succeed, citing spectrum and patent value, but the reality is a net profit margin of 0, negative EPS, and current revenue for 2025 at only $20 million. That beta of 2.7 confirms extreme volatility, and its price-to-book ratio is a whopping 22. This company is highly speculative, trading entirely on future potential, not current fundamentals. Past launch delays are a major concern. Even insiders are net sellers. This was a stay away last week.
I get the risk, Brooke, but the potential is astronomical if they get those satellites up. The partnerships with major telcos and the move into defense work show some tangible progress. It's a high-stakes bet on disruptive technology. For those with a high risk tolerance, the upside is massive. For most investors, the current financial reality makes it too dangerous. The potential for future KPI improvement is enormous, but it's still very much in the realm of speculation. For ASTS, it's a stay away for the general audience. All right, let's wrap up our daily hunt. Today, we covered a really interesting mix of market commentary and AI-generated insights. Here's our compiled list for deeper analysis. Investigate as buy, Microsoft Corporation, MSFT, Apple Inc., AAPL, Toronto Dominion Bank, TD. Investigate as cautious buy, none. Investigate as speculative gamble, AST Space Mobile, ASTS.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
That's all for today's Daily Hunt for Multibaggers. Thanks for tuning in.
We'll be back tomorrow with more AI-generated market insights. Until then, happy hunting.